credit for it. And this shows you how people just don't understand what's going on. It took a long time for these problems to bite. I mean, it took a long time for the chickens to come home to roost. But this is not the problem. What's happening right now is not the problem. What was happening in 2002 is the problem, in 2003, in 2004. And I correctly understood that our economy was a house of cards, that it was a disaster waiting to happen. I didn't know how long it was going to take for the you-know-what to hit the fan, but the fact that I pointed it out years ago doesn't mean I've been wrong all these years, and it shows you that my critics still don't understand what's going on. They were the ones that were wrong. They were wrong 5 years ago, and they're still wrong. They don't understand economics. They don't have any clue what's happening in our economy or why or what needs to be done to solve the problems. They still don't realize that what the government is doing is making the problems much, much worse. But it's still interesting to see how people are in denial. And even when it's obvious that I got this thing right, that people are still trying to find ways to say that I just was lucky or I don't know what I'm talking about, because they probably don't want to acknowledge what I'm saying now, and they don't want to believe the things that I'm saying now because they don't want to deal with the truth. They don't want to deal with reality. Or if they're in the investment business, they don't want to confront the fact that their clients are losing a lot of money and they're never going to make it back. I'm not worried about the fact that our accounts are down now because they're not going to stay down. And also, as far as when they attack me for that, I don't run money, right? I'm not a fund manager. I didn't have the ability to short the market or I don't have discretion. The money that we have for our clients is the money that was specifically sent to us to buy dividend-paying foreign stocks. Now, we did buy a lot of gold for our clients, but they're not in our accounts. And our gold investments, our physical precious metals, obviously have held up a lot better on paper than a lot of the stocks, but the physical gold is not in the brokerage accounts. It's at the Perth Mint. I also recommended that people keep some money in cash to take advantage of what could be an unexpected buying opportunity, which is what we have now. Most of my clients who kept cash didn't send me that cash. They kept their cash in another place. They sent me the money that they wanted me to invest. So it wasn't like we told people, put all of your money in stocks, but certainly the money that my clients sent me to put in stocks, we invested it. That was the whole reason that it was sent to me, to buy dividend-paying foreign stocks. I did occasionally recommend that if people wanted to speculate, that they could short stocks. I said that the best things to short would be the financials, the home builders, the retailers, and of course, if anybody took my advice, they made a lot of money gambling on the short side. I thought it was a gamble, but obviously the gamble paid off. If I was running a hedge fund, then I probably would have done that with people's money. But that's not what I was doing. Also, we gave people the opportunity to short subprime mortgages. Some people took advantage of that, got into that hedge fund, and made a lot of money. But again, those investments are not part of the Euro Pacific Capital accounts. The accounts that we have here are for people who want to take money and put it where I know it ultimately is going to retain its value. And between now and then, we wanted to collect dividends. And that's exactly what we've done. And that's why we made sure that all of our clients were investing money with at least a 5-year time horizon. The idea was not to put money in the market that you're going to need. I mean, even in my book, I mentioned that you need to keep a year's worth of cash on hand and don't invest money in the market that you think you're going to need. And as far as I'm concerned, the fact that the stocks are down right now, if people don't need the money and they don't have to sell, then they're not going to be impacted by these prices. And again, there's a difference between, buying a stock at 50 times earnings and then watching it get cut in half to 25 times earnings and think that you can just hold and get your money back. That's not going to happen, because if you overpay for a stock and you buy it at a high price and it comes down, but it's still expensive, just not as expensive as when you paid for it, you can't just hold and hope. That's not going to work. But that's not what we did. If we bought stocks that had an 8% yield that traded at 8 times earnings, and now, because of the market conditions, the stock's got a 20% yield and it trades at 3 times earnings, right? That stock can come back very easily, because there's no way it's only worth 3 times earnings. But in a massive margin call liquidation, unwinding what's going on right now, a once-in-a-lifetime event, that could happen. But when these circumstances end, normal prices should come back. That's why I'm not worried. Plus, in the interim, we're still getting all of our dividends. Somebody who bought some momentum stock that didn't pay a dividend in the NASDAQ and is now down 50, 60, 70, 80%, they're not going to get their money back. And they're not going to get any dividends. So you have to understand what you own, and if we buy quality companies and we don't overpay for them, then we can ride this stuff out. But a lot of people who are riding it out in the wrong stocks. Just like I mentioned yesterday, that discussion that they had on CNBC about Cisco. Here Cisco is again, a new 52-week low. It's at $15 a share. It pays no dividend. Obviously, if somebody bought that stock, if you bought it in the NASDAQ bubble like they were bringing it, if you bought it in 2000, that stock was at $80. And here it is, all these years later at less than 15. Obviously, you can't hold that stock and expect to get your money back because you know what? It's still overpriced. It's trading at 11 times earnings, which, might seem, not ridiculously cheap. Not expensive, but no, you have to remember, number one, their earnings are going to decline in this market, and compare a stock trading at 11 times earnings to all the stocks that we own in our clients' accounts that are trading at 2 and 3 and 4 times earnings. They're not even close. If our portfolios went to 11 times earnings, nobody would be down. 11 times earnings would be huge for the stocks that we own. So, it's night and day, and you've got to understand the difference between the types of stocks that we're buying and the types of stocks a lot of other people are foolishly buying, and they're going to be holding them for a long, long time, collecting no income at all, waiting for prices that will never get back to what they paid, at least in real terms. At some point, nominally the market's going to go down. Oh, and one thing I also wanted to mention before I take your calls, if you want to watch that video, it's one of the earliest ones on my website. And I think I have it in there. It's not even in the year because I didn't have anything in there. So if you go to video interviews on resources on the Europe Pacific Capital website, and you want to see an interview I did a long time ago, you go to 2005 archives, second quarter. That's the oldest one there. And there I have an interview from Southland Today from 2002. And it's a great interview. And the prediction I made that was wrong is I predicted that the NASDAQ would go to 500. At the time, it was around 1,400, 1,500. And I predicted it would go to 500. And obviously, it didn't get there. But I started predicting NASDAQ 500 when the NASDAQ was at 5,000. I said, okay, we're going to have a 90% drop. So, it wasn't that bad a call. We went down 80% instead of 90%. But the only reason the NASDAQ didn't go to 500 and the Dow didn't go to 4,000, which I also predicted, was because I didn't predict that Greenspan would lower interest rates to the extent that he did. I saw a housing bubble forming that I thought would have burst probably by 2004 at the latest, and I didn't think we'd get those ultra-low interest rates, and I thought we would have had our day of reckoning much sooner. The fact that he did drive interest rates down to 1% and blew up an even bigger housing bubble than the one I was talking about as early as 2002, I didn't know it was going to happen. But now I think the NASDAQ is going to fall. I don't know if it'll make it all the way to 500, but adjusted for inflation, it'll probably go even lower than that. But it might even make it in nominal terms. But again, just because I saw these problems in 2002 when it was not too late to do something about it as a country doesn't mean I was wrong all those years. It just means I understood the problems all along. And the problem simply got bigger and bigger and bigger because everybody else in the world was clueless. They're the ones that got it wrong. They looked at a giant bubble blowing up in front of their eyes, and they didn't understand it. They thought that the bubble economy was legitimate wealth. People confused asset price inflation with legitimate wealth creation. They confused conspicuous and reckless consumption with economic growth. They're the ones that had it wrong. I had it right. I've had it right for years. And ultimately, I think we're going to have it right on the investment angle, too, and I'm as confident as I've ever been, and probably more so, that we've done the exact right thing as far as getting out of the dollar and owning equities. We just have to wait for the dollar to turn around, and that will happen. Anyway, let me quickly take some calls that are building up. The number is 888-678-9597. First caller is